Happy Friday, everybody. It's January 26, 2018, and today we are presenting two distinct day trading time frames. Just a few quick things to go over. Jim, if you could go to the next slide. With regards to housekeeping, we've had several people contact us with regards to trying to access the old site and the old site material. As you all know, Jim and Julia both have brand new companies, and unfortunately, we do not have control over any of the old sites or access to them. So just want to let you be aware of that. And also, we've had issues with whitelisting, people's our emails going to spam. So if you could, please take a quick moment to whitelist us so that you can receive our email invites and marketing emails to let you know what's going on with us. You can go to the next slide, Jim. These are just the instructions. You'll be able to access the slides later with the recording if you need these instructions. And I will turn it over to you, Jim.
Thank you. We've got a little mislabeling on the name of the presentation. What I want to talk about is two distinct time frames that take place within many of these days. So we're going to lay out what we're talking about here, and then we're going to go and we're going to use yesterday as an absolute perfect example of what we are talking about. The easiest way when you first begin, and maybe even all the time, to think about using the market profile to organize the market's continuous two-way auction process is to think in terms of the day time frame and all others, with the day time framing being those that come in flat and those that go home flat, and then all others meaning anybody beyond the day time frame that can take trades home overnight. It's a very important. Hold on one second. I'm sorry. My throat decided to act up. It's very important that, number one, you understand the day time frame references, and secondly, understand what they are saying to you. Typical references are the overnight high and low, the settle or unchanged from yesterday, the opening, the previous day's high or low, previous 30-minute bar high and low when the bars are bunched together throughout the day. So sometimes you'll see 3 or 4 30-minute bars all within a tick of each other. When that happens, that's a sign of where the day time frame is bunching up together. That is always subject to a lot of stops there and being taken out earlier. We're always looking at the previous day's high and low. And then I've labeled the last one dynamic. These are day time frame references that develop once the market opens. For example, the market may open and make a low and then rally. When that low is made, that low now becomes a day time frame low. And we're going to see the importance of that again when we look at yesterday's market to have a better understanding of this. The reason we want to think so clearly about the day time frame is they are the weakest of time frames, and while they may take markets for several handles, they can be routed very easily, and you see them go into liquidation mode. The day time frame, as I said, are the weakest of time frames. They react to very visual references. When the ones I marked before are all very visible. The opening, the unchanged, or the settle, previous day's high and low, etc. They keep the market relatively close to the previous day's range. And we used to see this when I was on the floor of the exchange years ago. I mean, the local traders, which there aren't locals anymore, at least very rare, they would, very important to them was they would try and reference on the previous day's high or low. It wasn't the locals' job to take the market out of existing ranges. As we said earlier, they come in flat, they go home flat. But more importantly, what they do, if another time frame starts to take the market higher, these day time frame traders pile on very quickly. So if another time frame starts to extend the market or starts to show a rally, then you get a tremendous amount of piling on by the day time frame. You're going to see a pile on yesterday afternoon that got them in a lot of trouble. They are emotional, and they have emotional reactions to news and other relatively minor events. All other time frames, they're important for the directional moves, and various combinations of players, long-only managers, private independent traders and investors, and sometimes these are very large, very wealthy individuals or very wealthy, private companies. Then you have large pools of leveraged capital, and the one I really want to focus on is the large pools of leveraged capital. This is something these have sprung up in the last several years, but they are hedge funds. They are organized trading entities, but they employ large leverage, and some of these pools are very, very big. You can have billion-dollar plus pools with leverage, and they can move the market substantially higher or lower. To better understand what we've been talking about, let's immerse ourselves into Thursday's market. Now, before we do that, let's just take a look at what's happening right now. The market has made one of the daytime frame references. That's the overnight high. We have a poor high because A and B match. That also becomes an important daytime frame reference. Okay, we'll come back to that market from time to time. But what I want to look at is yesterday's market. I'm going to add more of the overnight trade to yesterday, and I'm going to split out yesterday for right now. Okay, as we came into yesterday's market, the overnight inventory was about balanced. It had been short most of the day, but then late this is the overnight inventory. It had been short. We always measure it relative to the previous day's settle. And then later in the morning, they rallied the market substantially. And that probably came in with overnight inventory that was balanced. So that really wasn't part of the equation. We opened within the previous day's range. Extremely important. When you open within the previous day's range, the best odds are that you're going to have a rotational day. Now, if you're really close to the previous day's range, high or low, that can change very quickly. But when you're pretty well in the center or in the good healthy portion of the previous day's range, the odds are so high that it is going to be a rotational trading day. Now, to add a little more context to this, also today was an important number, and that was the first look at fourth quarter GDP. Now, the market hasn't had much reaction to it this morning, although value is building higher. But it's a lot of times any longer term investors or even these leverage pools that were going to make adjustments prior to the GNP announcement, they have probably completed those adjustments going into Thursday. So it is not uncommon for the day prior to a major announcement for the market to be mostly shorter term traders. Okay, so yesterday we opened within the previous day's range. We have a very prominent point of control from overnight. The odds are always good that that point of control will be revisited. The wider they are, the more likely they are to be revisited. Now, earlier in the week, we had a big rally or break that didn't revisit that. Sometimes that happens, but it's something that you crank in. Last night's very prominent point of control right here was not revisited, but we're within a couple of ticks of it. It's also half back, which is also a day time frame reference. So I wouldn't put a lot of faith in this down there. Very easy to take that out. So we have a poor low, a questionable low. We have a questionable high. Okay, I'm going back to yesterday. I don't normally talk about trades that I do, but I am going to talk about them yesterday just in order to make this a little more real. When the market was overnight when we were up near the previous day's high and up near the all-time high, I bought some puts that expire today. And my thinking was I didn't have a lot of risk because of the trade location. The odds are we were going to open in the day, a very prominent point of control from overnight, and a decent chance that we would get liquidation in the morning. We did get the liquidation. So it was quite a healthy liquidation in there yesterday. Notice that the low took out the overnight low, and then we got a poor low, which is a double AB. So remember, we then say that that B period low is now a day time frame low. That means it was made by, the likelihood is it was made by the day time frame traders. The first low was probably made by the day time frame traders because we're still within the previous day's range. Yesterday's B period low was poor, probably made by the day time frame traders. So it's suspect. Now it may make it throughout the day, but it is suspect. So as the market broke, it gave me a very quick profit on the puts. At that point in time, I didn't do anything. I got out, I stepped aside, and I just let the market trade higher. In C period, as the market was having trouble getting by unchanged, I shorted futures. I had to take those futures off with a 3-point loss because what I thought the market might rotate lower. I took the futures off with a 3-point loss because they did not rotate lower. So at that point in time, I have a profit on the first puts. I have a loss on the futures trade. As the market rallied, and it really didn't seem to be much here, I went back to a put position. Again, what am I thinking? I'm in an inside day. I'm expecting a rotational market, and I'm playing it that way. So the market is up in someplace in here. I buy the puts. The market comes down, it rallies, and for a while I wasn't sure what I had. But I stayed with the trade, and part of it was that it kept coming down to around the unchanged level. There's unchanged right there. Whoops, wrong. Unchanged right there, and so the H period goes 2 tick below it. I period goes exactly to the unchanged and then rallies. So it honestly didn't worry me very much, simply because I figured this is low. This is a weak low. because it is exactly at unchanged. Who buys exactly at unchanged? That is day time frame traders. So much is important to understand the day time frame trader and understand their visual references and understand how they act and what is to be expected of them. Now, let me just sidestep here for a minute. In H and I period, there are I see two potential strategies for day time frame traders. Okay, I usually look a little longer in the day time frame rather than short trades. But a day time frame trader that is quick can buy this H period low, sell it on the rally. They can buy the I period low, sell it on the rally. What they have to understand is the person that does that, the makeup of the person that is buying those day time frame references. If they're good daytime traders, they understand exactly what they're doing. Their personality is one that is very quick. They do not get married to a trade. They don't ponder if the trade's any good or not. They act very much like a well-trained football player or athlete that's just going with the moment. So these are very legitimate places to buy for very short-term daytime frame traders. But remember, the personality has to be very quick. You can read the book, which I like very much, Thinking Fast and Slow by Daniel Kahneman. It's a good read to understand this kind of thinking. Now, the daytime frame trader or the other trader that does not buy these lows is what I call the ponderer. Somebody that if they buy this and it goes really back fast down below it, they think, oh, well, I can't get out here. Let me think about this. That person will get murdered. So it's the personality and it's the style of that daytime frame trader. Now, what my type of daytime frame trader is different. I use this information and I'm saying the daytime frame traders are the weakest of personalities. And since this market's an inside day, if they rally the market, they're liable to get inventory too long and then come out of that trade if anything starts to pressure the market. So again, I'm up here early on. I think it was G period, F or G period. I bought the puts. So I didn't worry. I didn't do anything when it got down here. Then I rode it through here. I was, not too worried, but it wasn't looking very good. Then it down again and then back up, and I stuck with the trade. Okay. Now, in J period, the market breaks down. It takes out the H period and the I period low, and you can pretty well guess there's going to be stops there because that's where daytime frame traders were buying short-term trades. And like I said earlier, if your personality is something, if it doesn't work, you're out very quickly. But if you're a ponderer and you're going to think about the trade, you have the potential to get run over. So now we break in J period, and the market then rallies back up in K period when it stops just before unchanged. Well, I'm a little uncomfortable now, but they break the market again. When they break the market again, and we're just a couple ticks short of the early morning low, I get ready to liquidate my position. As soon as they take out the AB low, I am out of my position. That was in the morning. I said it was a weak low. I had it marked. I was ready for it. And then the market rallies sharply in L period, goes back down. I don't remember exactly how it happened, but it goes back down in L period. What I want you to know at this point in time is, given the fact that the confidence overall was low, this market would rally, they'd sell it. They'd rally, they would break It rally, they'd sell it. Break, they rally, they sell it. They were getting very little out of this. Then you got the break in L period. And what I'm watching in L period is I'm saying, I think that these short-term traders are selling in the hole. Now, notice that the point of control, let's put this back together. Let's collapse this. With all this selling, this was the original point of control. There was, early on, it did not move lower. So they're selling, and as I'm watching this wave after wave of selling, and yes, they took it lower than when I got out. They rallied it, they sold it off again, they rallied and sold it off again. And I'm watching, and what I want you to feel right now, and if anybody was out there was to get caught the way I think a lot of people did, it was just this non-discriminate sell, 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 because they got to the point where they're thinking, I got to sell. They're selling every rally. And I'm watching, we're still inside day. We're still inside day. The point of control at that point in time had not dropped, or if it had, it was very minor. So the fairest price is the point of control. The best way to think about the point of control, it is the fairest price. And now, as the market goes lower, if there's really anything there, you want to see the fairest price go lower. And what I was feeling is that they got the short-term day time frame sellers, they just got to the point where they just were selling everything, every little rally. And I guess that there was emotional people out there that just were totally convinced the market was going lower. As this market broke again in L period, I now stepped in and I bought the 40 calls. They expire today, but I bought the 40 calls. I think I paid, I don't know, I want to say I paid $300 for them, which would be $150 a piece. And I'm just saying, I wouldn't do it with futures because, I get scared. You never know what this thing really could do. But I bought the calls, and the market, I just said, I think they're short in the hole. In other words, short at very bad prices. Remember, overall, it's an inside day. And an inside day, I'm expecting rotation. If there was more to this selling, I think the point of control this was the original one, and I think it would have moved down substantially. It didn't. So at that point in time, I think they're trapped. So now the market comes back up. By the close, we're back up, about the middle of the range. There's the half back a little bit. So they brought the market back up. Try as much as they did. I'm saying that they couldn't break that market, and there was a tremendous amount of selling. Now, the buyers that came in down there, I'm going to believe, are not daytime frame buyers. They are that other time frame. Probably those pools of capital that are highly leveraged. They can go home long, and they are just buying that break. So you got the inside day, you got rotation throughout the day, and it was extremely important to understand what those references were that you were looking at throughout the day. So again, rotational day, inside day. But that example from yesterday shows you daytime frame sellers. It shows you more than likely, particularly on the low, where another time frame stepped in, time frame that could take trades home overnight. And there were some wonderful trades there yesterday. If you had an understanding. If you didn't have an understanding, probably very easy to have got trapped on the short side yesterday because they sold it off many times. Many times that market would rally, they'd sell it, it'd rally, they'd sell it, and they were getting very little for it. But if you're just looking at price, you could have actually been trapped and feeling, my golly, I got to with this. And I know the feeling because many times over the years that I have been trapped. How do you like it when you get the feeling, the report back, and you end up with the low for the day or within a couple ticks of the low for the day? It's a terrible feeling, and you got emotional. And I could feel the emotion yesterday before I bought my calls. I can feel the emotion, thinking, "Wow!" In fact, at one time, I even looked at lower priced puts. I mean, so I was feeling it, but I stepped up and I finally bought the calls as I'm watching what's happened. Was it easy? No. Was I feeling the emotion? Yes. Was I able to control the emotion? Yes. Okay, let me stop at this point. Let me take a fast look at today. Higher value, very questionable high, a questionable low because it is so close to the overnight half back, very narrow range on a Friday. If you will notice, it's not uncommon on Fridays for us to get a fairly narrow range if the options, because it's the weekly options expire, if the option traders can hold the market in a fairly narrow range. If they can't, then all of a sudden it's very common late in the afternoon to see a breakout from that range as these guys get trapped. All right, I've done a lot of talking without questions. Jen, let me open this up for questions, please.
Sure. A little off topic. Given the balance of the last 3 days, do you consider today to be an inside/rotational day too?
I don't know how to classify today. It's within the range up near the all-time high. It's outside of yesterday's range. It's come back in. I really don't have the high is weak. If you take a look, there's the overnight high. So visually, what the market was doing, as I said early on, day time frame references are the overnight high and low. They're the previous day's high and low, and and those are the numbers I look for. So they got above the very visual reference, but there wasn't any great selling. This is just a day time frame shorters up here. So it's a very questionable high. The low is questionable because it's so close to the half back and overnight. It's just a low confidence, and it's, to me, I have no trade on and I have no desire. There's nothing I see at this point in time that gives me any desire to put a trade on. Okay, other questions on what we've talked about?
Yes. This person kind of has a series of a few questions. First one is, do you watch period-wise volume for inside days?
I do look occasionally at the volume. The biggest volume I look at is the first half hour, and then anytime there's a substantial move. But I'm not terribly. Yesterday, I wasn't terribly glued to the volume because I was really in touch with what the market was doing. Okay.
Their second question is, would you have marked anomalies from Wednesday? Any other important reference within context? And their third question is, can you elaborate the overlapping periods of Thursday? What can we make sense of out of it?
Okay. I hadn't marked any anomalies yesterday. It's an inside day, and I basically was focused on the inside day and the rotational trading throughout the session. Now I'm going to split out yesterday again. And there was a lot of rotation in here. And yes, I did question what was happening on the rotation, but when I looked at the H and I rotation, because of its exactness to the unchanged from the previous day, I guess H was a couple ticks below it, and I guess I was one tick below it. Because of the exactness or closest to unchanged. Unchanged is a very visual, very common day time frame reference. If it goes to below unchanged, the market gets red. If it goes above it, it's green. And it's amazing how many traders don't do anything other than that. But when I'm watching these rallies, I'm saying I think they're getting the market longer and longer. So I think it's daytime frame traders buying at unchanged, and I think they're getting inventory longer and longer, and I think the odds of a late liquidation have increased substantially. Other questions?
Yes. How far out are the options that you buy?
Generally, I will buy as short as I can. So yesterday I was buying options that expired today, and I don't use any of the Greeks when I do options. I'm just simply looking at the option and as a substitute purchase or sale of the future. And the reason I'm doing that is it's I have trouble just when I'm dealing with futures, and I do probably 3/4 options, 1/4 futures. When I'm dealing with futures, you can get something, some little news or some little spike that forces you out of a trade that you really want to be in. Just because from a logical side, the futures can move so quickly. Now you may have a loss on the options, but it's not as devastating as the futures can be. And yesterday in particular, as this market was breaking, I got to admit, I had questions because it would break so hard, and I could feel the emotion. But I had bought the calls. I think I bought the 40 calls, if I remember right. And as I watched it break, I was very happy that I had calls because particularly afterwards, because I suspect if I had futures, I might have just said, I'm not sure the risk is worth this. Because, I mean, they can get really volatile. And for a minute there, it looked like, wow, it really is going down. And like I say, got to the point I was even looking at lower priced puts. Let me pass. And I had to basically talk to myself to tell me, you've been here before. You know what this is, at least the odds of what it is. It's an inside day. Don't get. I mean, I was feeling the emotional push on the downside. I'm curious. Jen is one of my partners, and I really want to say if anybody if anybody got caught in that yesterday, I'm not looking for names, but just flash an answer to Jen so we can see if people out there did feel that emotion, did get caught short in that late downdraft yesterday afternoon. Well, I'm waiting for some answers there. Other questions?
Sure. Do you not bother with the 4:30 to 5 p.m. time frame for ES?
No, I don't. I really turn stuff off about 4:15. The only time, there have been times when all of a sudden I wanted to do something, and I'm still around, and that late trading gives me an opportunity at a price I was looking for. But I don't pay a lot of attention to it. Okay, other questions?
How is unchanged determined?
Unchanged is to settle from the previous day. That's all.
I know you don't watch VWAP, or do you? But traders frequently use VWAP as a buy or sell point. Would you treat that the same as other visual reference points that everyone can see?
VWAP, is that value? Is that volume point of control?
VWAP is volume. I can't remember.
I'm sure it's
I
volume.
know what it is, but
Yeah. Now I do not use the volume.
But volume weighted average price. Thank you.
No, I don't. And I just, I don't know if it's right or wrong. All I know is I don't get that finely tuned when I'm watching the markets. I do watch the point of control to see if it migrates higher or lower. But I'm more concerned. I'm more concerned with the overall flow, what I'm reading in the overall flow of the market, rather than trying to get too narrowed down on something that's just can confuse me. I'm like yesterday was a rotational day, and I made 4 trades. I was wrong on one. I was wrong on the futures trade. I shorted it, and the market did get a short covering rally and take it higher. So I covered that with a 3-point loss, and I actually had done that in fairly small size. But the flow of the market gave me 3 out of 4 profitable trades for a very nice day. And I look at the flow of the market. I look at the TPO point of control. Now, the reason I don't use the volume point of control, there's 3 elements that make up the profile. They're time, price, and volume. Price is an advertising mechanism. The Time is how wide the profile is from left to right. And volume, I estimate volume based upon how much time has been spent at any level. So is my volume perfect? No. But the problem with using a volume point of control, it does not bring in the element of time. The element of time is far too important to overlook. If a trade, time regulates all advertised opportunity. If it's there too long, that's not very good. If it's taken up pretty quickly, that's a good sign. So time is very, very important to me. Time also controls the movement of this point of control. So it helps me refine what is really going on within the continuous two-way auction process that you saw yesterday. Okay, other questions?
Yes. Could you explain how you look and trade balance and imbalance?
Okay. Yesterday was a balanced day. So I just went through how I trade yesterday. Balance, it's in balance, it's a rotational day. Now, you can have other things. You can have a 5-day balance. If you have a 5-day balance, then what I'm looking for is, I'm looking for getting as close to the top or the bottom of that balance as I can to buy, long or go short. I'm looking to see if we're getting acceptance or rejection near the top or bottom of that balance. The days within the balance, I said, okay, it's within a 5-day balance. So the market's fairly balanced. I still may get some rotation, but the rotation may have a bias. It may have a bias towards the upside. It may have a bias towards the downside. Now, today is a particularly difficult day. Remember what I said early on, it went up here, and that was a very questionable high. It was a day time frame high because it was AB. It's not a very secure high. Neither is the low very secure, but the high was less secure than the low. And look where we are. We're right back to it at this point in time. So again, now we have a balance. And we're right up against the balance, top of the balance, and we're against the all-time high. So I'm looking at that very closely. Couple more questions.
Could a stock like Apple lead the market lower? It seemed like that was happening yesterday.
Yes, there are times when you'll have undue influence from a particular stock. But my caution is, and people all the time, they tell me they follow, they trade the ES or the SPY, but they're always looking at the NASDAQ or oil or something else. And that's a caution. I say stick with the market you're trading in most cases. And the reason for that is that, if the market is triggering off of Apple, guess what? It's going to be built in to the profile of the current market you're trading. If it's already in the profile and then you look at it and you think that's going to give you information, you easily will be overweighting or giving at least double weight to Apple. So it's very dangerous to trade an ES or the SPY and base it on what's going on in another market, because that information more than likely is already into this profile unless you're the only one that has that information. And it's very unlikely that you and I are going to be the first ones to have that information. Okay, 2 more questions, please.
Do you not find the theta decay in the price when long options to be a problem? If yesterday's trades had not moved in your favor immediately, would you have exited them or held on?
No, I'd exited because I understand that it's going to go very quickly. I don't worry about the decay in the options because I'm in them. In most cases, I'm in such a short period of time. From time to time, if I'm going to do something that is for a couple of days or a little bit longer, I may go out a week or 2 on the options. But when I'm using options that expire today, I'm in and out of them very quickly. To me, I'm just looking at a way to be delta long or delta short the market. And I can do that with an option. I have a lot less risk in there. Okay, let's take a look at today's market. Remember, we said early on that was a very questionable high. And one of the other things I said, value is higher. So where are we today? We're looking at higher value, and we had a poor high. The chances of getting much break out of this market early on, very, very low. Remember, because this AB high, who made that AB high? That's not longer term money. That's very short term day time frame money. So now we're up near the all-time high, and we're just there's 2 ticks above it. So the market's stopped 2 ticks short of that. So it's something they see, very mechanical, something they're after up there. So that's the upper reference. If there's anything in this market today, more than likely we don't come back down to the AB price. More than likely you get through the all-time high and get the stops and continue. All right, final question, please.
There is an emphasis on not trading the first 30 minutes because of the chop, yet it seems you still make trades in the first 30 minutes. When is trading the first 30 minutes okay?
All right, it's very interesting, and I think about that often because I talk about trading in the first 30 minutes, the first hour, because of the chop. Generally what I mean by that is I don't trade immediately on the opening. But everything I say and every rule you ever see is always contextual. What are the other circumstances? For example, yesterday I traded early. In fact, I traded before the opening because the overnight range, let me put the overnight back up here. Because the overnight range gave me a trade location that was very close to the all-time high, and I thought I had very limited risk. So again, there's always something. And for example, and this is where when I say things like that, without understanding the complexity I may be talking about, is, for example, if in fact you don't trade immediately off the opening, but the market then goes up and takes out the overnight high and fails, well, that may be 5 minutes or 10 minutes after the opening, goes to the overnight high and fails, that very much may trigger me to get into the market. It very much may trigger me to get into the market, but it wasn't right on the opening. Now, yesterday morning, there was, I had my position already, but there was just a tremendous amount of chop early yesterday morning, and a lot of rotation and a lot of chop. It could have easily, you could have easily found reasons to go long and short in that chop, and I stayed away from it because I already had a position. Did I question myself? Yes, I did. But trading the first period, if you've got a breakout to a new high, or you got a breakout from something, go with it, whether it's in the first 30 minutes or not. But generally speaking, when I talk about that, I'm saying to people, unless you have a reason, you have a reference, and it failed at a reference, stay away. Let the chop work. It is so easy to get caught up in that chop. Think the market's going, oh, I think it's going higher. Oh, I think it's going lower. Jen, did anybody come back and tell us they got caught short in that late push down yesterday?
Yes, we had some people that said yes.
Okay. That is just, when that happens, that is where your emotions have taken over, and it is so hard to control your emotions. Believe me, I have been there so many times over the years. 40 years or so I've been doing this, and there's probably not a thing you do out there that I haven't done wrong. And that push down yesterday was very easy to get caught. The only thing that would save you is saying, where are we? Where it's an inside day. We haven't even gotten close to taking out yesterday's high or low. Look at the point of control your emotions. And sometimes what you have to do, sometimes you have to get up and walk away from your machine in order just to break the pattern. I'm reading an interesting book. I don't know if I would suggest it for a lot of people, but I was out at Costco the other day, and in the book section, there was a book called Tribe of Mentors, and since a lot of what I do is on the mentoring side, I couldn't help but pick the book up. Now, I haven't read the book, word by word, but I've skimmed everything, in the book. And one of the things that I find, some of the greatest scientific people in the world with making great discoveries, it is amazing to me how they will talk about the need sometimes to step away. They're working on a formula or something, they have to step away. One of the guys in there that's got some substantial, developments, scientific developments, he will go and play solitaire on his machine just to break the thought pattern and get totally away, refresh his mind so he can go back thinking. We all have a tremendous amount of trouble controlling our emotions from time to time. And I work on it. I have to work on it. The new intensive that we're coming up with, it starts on February 26th. Anytime, if you're really going to help people trade, it has to be a good balance between market understanding and self-understanding. If without self-understanding, yesterday would have been probably a disastrous day. With the self-understanding, which only took almost 40 years to learn, it was a good day because I concentrated on what the market was telling me. And that's one of the things that, as we go through this new course, one of the things that we do is try and get a balance between self-understanding, market understanding. Self-understanding was really the key to yesterday afternoon. And before we wind up, the particulars of the course are here. If you're interested, and you can
The slide before, Jim.
DaltonTrading.com or JimDaltonTrading.com. You can call us, you can email us in there. One of the things we're doing, while the intensive doesn't start until the 26th, I believe it's the 26th of February. Starting February 1st, I am going to put out a daily market letter. I'll do it in the evening. I will do an update to that in the morning. And I'm going to open up the chat room so that I am chatting comments throughout the day in order to give you a head start on, really understanding what we're doing and picking up on the intensive. Now, the chat comments throughout the day will not be as intensive as they are when the real intensive is underway, simply because from time to time, I have some other things I need to do and take care of. But I will be chatting every day. There will be 2 letters a day, and we start on February 1st, and the goal is to really get the process in your mind to give you a much fairer chance in order when you enter into the intensives that you have a head start and you have a much better background in order to really take some value away from the program. Let me thank you very much.
Jim,
yes.
Could you
yes.
go up to the slide above this one that has more details about the course?
Oh, okay.
And then also, we still have plenty of questions and about 10 minutes left.
Oh, okay. Go ahead.
Okay, so one of the questions was, how do we distinguish price acceptance, which by definition would show an increased volume at a price range, versus absorption, where price is spending so much time the opportunity for further extension is decreasing, odds-wise?
Okay, there's no pure answer to any of these questions. It's contextual. It's always my cop-out, it's contextual. But you're understanding how did it get to where it is? And then you're looking at volume, and you're looking, is that price accepted or rejected? For example, as we went up and took out the all-time high this morning, we said this was not a very high confidence low down here. And, it wasn't a high confidence high. So there wasn't high confidence to begin the session. So now we went up and took out the all-time high. And at this point in time, it's been rejected. Now, what would show more confirmation of that rejection? That would be going down, getting back in to the ABC range. In other words, closing out this upper distribution. So again, you're looking at a composite of information. You're looking at volume, you're looking at time, and you're looking at the overall flow of the market. There is not an exact answer to that question. It comes with experience. And that's really what we're talking about. If you think about the development of any skill, there isn't a skill in the world, whether you be a professional basketball player, baseball player, that it takes a long time to fully develop that skill. And every time you get involved, you pick up another nuance, you pick up this, you pick up that. And it's really based on experience. The difficult thing with trading is that every time you place an order in the market, you are placing that order against the best in the world. These are, because the ones that aren't the best, they get cut out very quickly. So the problem with trading, it's not like tennis where we have a practice court or a ladder, and you can work your way up with who you're competing against. It just doesn't happen when you're talking about the markets. So that makes it difficult. One of the things, what I'm trying to do is I'm trying to give you, as a mentor, I'm trying to give you an advantage of my 40 years of experience. And I'm trying to package that into self-understanding and market understanding. And as I say, something by understanding acceptance or rejection, it's not a single solitary answer. It is a composite, contextual, based on your experience. Some of that will be, how did we get where we're going? Is there acceptance or rejection? What's the volume, etc. Another question.
Yes. When you buy calls or puts, do you buy simple calls or puts, or do you buy a vertical? For example, buy a call and sell a call at a higher strike to reduce the cost, or buy a put and sell a put at a lower price to reduce the cost? If not, why?
Now, what has happened to me over the years, I've tried all of that. And some of you may know I was the number 2 person at Chicago Board Options Exchange during its early formation. I'd also worked substantially with over-the-counter put and call dealers prior to the options exchange. So I've been around a long time. The biggest errors I have made in trading is overcomplicating the situation. So when I buy a put or a call, in most cases, it is simply an outright purchase or sale. I don't complicate it with, making a bull spread or a bear spread or anything else. I find that is very complicated, and it gets too complex. What I will do from time to time, if I'm going to do anything, if I'm long a call and the market goes up, I may short futures against that long call. It won't be 100%, but I may short 30, 40% of the futures against that call, because my short is protected by the call. So I will do that. If I have puts, the market goes down, I may buy futures against those puts, looking for a trade because I'm protected by the option itself. Never do I go 100%, but more often than not, I am simply using the put or call as a substitute purchase or sale of the underlying future, and it's done for a very short period of time. Okay, go on.
How much do you pay attention to the previous day's value area high and value area low?
Very little. my attention is on, my biggest attention is value building higher or lower. And I'm always looking at the previous day's point of control. What is going on relative to the previous day's point of control? And then I'm just looking at what is today's point of control versus yesterday's. So, but no, I'm not, what I've found over the years, if I get focused in on, something very exacting, like the high or low, a value area high or low, it can really cause me to lose sight of the bigger picture. Okay, other questions?
Hi, Jim.
I'm sorry. Let me go back to that. Earlier I used an example and I showed, for example, you go buy unchanged if in fact your personality is one that is very quick to get out if it doesn't work. And you saw yesterday, even though it went down and it bounced, let me split this out again. Okay, it bounced. H period went just a couple ticks below unchanged. I period went a single tick below it. If I have the personality that's quick, you can buy that for the bounce. But your personality, as I said, has to be one. If it doesn't work, you get out immediately. Now, I know that there is, some trading that takes place around value area highs and lows. And the reason for that is it's very exacting. A lot of people talk about it. And, anybody can look at a profile and, figure out where the value area high or low is. So yes, there is some trading for there. But the same thing as I said about buying yesterday's unchanged, you want to buy the high or low, understand that if it doesn't work, you got to be out immediately. It's not one of these things that, well, let me think about this for a while. I'm sorry, Jen, I interrupted you.
Oh, no, it's okay. Hi, Jim. Great to see you back in action. I know your usual MO is to wait for one time framing to end on a down move before getting long. But yesterday, for example, maybe I was trying to be cute, catch the bottom of the morning sell-off. I was watching the market taper into the previous day's POC, and when I saw a double-digit print, I went long. Usually this works out pretty well, but sometimes, like yesterday, it will bounce a few ticks, then do a lower low on a taper, rinse and repeat. So what context would you be looking at to determine? Well, I guess the rest of the question got cut off.
I'm looking at the overall. I'm looking at the overall market. Value going to be higher or lower? Am I inside or outside the previous day's high or low? I mean, a lot of times, if something, for example, you may buy a poor low. Yesterday morning, let's go to yesterday's morning. Let's split it out again.
Oh, I found the rest of his sentence. If you'd be expecting a continued dribble downwards or if we'd find sufficient support.
I don't know, but there are times, for example, yesterday, the market went down and it left a poor low. It was a good buy. It was in the previous day's range, and somebody that's quick, they can buy that low. Understand that if it doesn't go up pretty quickly, watch out, because it comes back down through there. It can go pretty quickly. Now, yesterday, understand the context. Yesterday, look how wide A period is, and then B, and B is right down to it. You probably got the market very short. A lot of times you can have a poor high or low if the market is too long or too short. So more than likely, they got the market too short yesterday morning, and then you get the bounce. Other times, but remember, I use this information that this was a questionable low, that was part of what it figured into, my puts later in the day. That the chances were fairly decent that we might break back down and take that out. In other words, it wasn't a strong low. It was a weak low because there was no real excess. And you see, we did come down and take it out. There are other times when I may be looking to get short, and I get a poor low like that, and I may sell the first bounce because I think the chances are pretty good we're coming back. But again, it's not a direct answer because everything we're looking at is contextual in the market. Yesterday, we were within balance. Being within balance and as wide as we were, as much selling There's all single prints. It was just too many single prints to think all of those single prints would remain throughout the day. So that made this a better buy. Again, there's no exact answer. Okay, let's take a fast look at yesterday. Twice we've been up against the all-time high. Twice we've sold off, but we have yet to trade back into the early range. So we still have a double distribution. If there's anything on the downside, I think we need to close the double distribution, print at the AB level, and then start to see something go lower. Right now we have a double distribution day, and we have not gotten back down into the ABC early range. So what kind of buyers are in here? These are momentum buyers that are buying exact levels like that. Is this strong buying? No, it's not. If it's strong buying, we'd be up and we'd carry through. They got up here, they got the stops. But is the selling strong? No, it's not. So again, you've probably got some short-term traders or very long in here, but the key is looking at the double distribution. All right, a couple more questions.
Sure. Have you ever seen a blow-off top, and what could a trader look for to identify it?
Yes, I've seen it. I only remember one in my life. I remember two. I remember one in the S&Ps, and I remember one in the Japanese yen years ago. But again, I think sometimes we spend too much time looking for the blow-off top, blow-off bottom. I'm afraid we're going to miss it. Look at the market overall. Look at the market overall and see what happens. If you got a blow-off top or a blow-off bottom, guess what? You don't have to be right immediately because you're going to have a lot of time on the downside or the upside depending on what it was. But the context, the last time that we had a really interesting low in the S&Ps was a couple of years ago, and the market went down, and prior to going down, there were 7 days, I think 7 or 8 trading days in a row where you had a prominent point of control that wasn't revisited. So that market was just getting unbelievably short in all time frames. And I remember, I want to say the break was 9.99 or something like that. It was just a very mechanical break, and you didn't get a blow-off low, but what you did get is you did get a swoosh down that was met by buying. There wasn't any clear buying tail. But the context leading up to it, like I said, I think 7 days in a row, there was a very prominent point of control that hadn't been revisited. And that's usually a sign that emotions have taken over. Emotions have taken over, and traders of multiple time frames are selling any rally. And then, of course, there were people saying, well, they're going to buy a break. And I think it was like 9.9%. I mean, very, very mechanical. Okay, 2 more questions.
Okay. Do you watch the VIX futures or NYSE ticks like some do? I have noticed that the market won't go up if the VIX is rising short term.
I will occasionally look at the VIX to see where it is. For example, I've looked at the VIX recently. I don't have it up. What is the VIX right now?
Anybody know? They could post it in here for me to tell Jim.
No.
I don't have it up. 11.25.
Okay. And that's, it's been running around 11%. Even on the breaks the other day, when we had a big break, you had a big break on the 22nd. Was that no? When did we have the break? No, on the 24th. You had a break on the 24th. Oh, no, I'm sorry. Yeah, you had a break on the 24th. The VIX didn't pop very much. When we have a break that they really get excited about, you'll see the VIX pop to, you can put up a bar chart, you'll see it park to 17, 18 pretty quickly. I think it stayed around the 11 the other day. Do I look at it? Yes. Am I aware of it? Yes. Is it an important thing to me? No. Okay, we have closed the double distribution. We've looked up above the old high. We have failed, at least at this point in time. We've closed the double distribution. The next price people will be looking at will be half back. Half back is right here at 28.51. And then if they go through half back, then they're looking at, I think this is a very questionable low this morning. Okay, one more question.
Okay. You mentioned the market is too short or too long. What is this based on? The distance away from the market is from the POC?
No. You can get to yesterday, for example. I mean, some of it's just common sense. When you look yesterday, you had this huge break in A period. The low in A period was 28.33.75. The high was 28.49. I mean, look at it's just a huge break, and you're still within the previous day's range. The chances that that market got overly short are huge. Does it have to be? No, but the chances are short. Traders just emotionally just sold. They got it too short, which is what happened. So again, it's not looking at exact points. It's having a feel for the market. And this is why I'm going to tell this story again. I can be very boring, but when I started doing education, it was done through courses that were kind of linear in description. And what I found out that people really couldn't go put that to work. Then I went to the next stage, was doing courses on a stage in a conference room or a hotel or something of that nature. They'd be 4 to 5 days. Those worked better because you had at least 4 or 5 days to explain what you're talking about. Go back and find actual examples in the market. But that really still is not, you can't absorb the information that fast. And like I say, so much of it is being able to get in the flow and look at many different types of markets. That's when I then went to the intensives where, this intensive, the first one is 5 weeks, then there's 2.5 weeks in between, and then there's another one for 5 weeks. So it gives me a total of about, 12 or 13 weeks to, give people a much better chance to absorb the information, understand the flow, become part of the market rather than just trying to memorize value area, high lows, POCs, things like that. There's far more to it than that. You have to be in touch in the market. The first book I wrote, Mind Over Markets, really isn't about trading. It's about acquiring any skill. You play the piano, you start with the white keys and black keys. When you get the competent, with the third stage, you can play Beethoven exactly as it's written. That's not going to make you any money in the market because you're competing with proficient and expert. Proficient is the next level. Then expert, you in the market are one. Say a race car driver, he's one with the track. And that's really where we're trying to get you with the market, as I'm trying to take my experience and get you to the point where you do understand that. Now, how does it? You start with learning the rules. You start with learning the value area, the point of control, things like that. You start with learning that, but then it just keeps developing. One of the things I say, when you go from competent to proficient and expert, you actually have to jettison some of the rules that got you to competent in order to move on to proficient and expert. That's the way it is in any skill-based things. You'll see professional golfers, for example, change their swing after being very successful in the market. They'll change their swing because they want to get better. So I'm sorry, that's a very long-winded answer, but it is the point where you get to where you do have a true understanding of what's going on. One of the things that we start with on the last intensive, I introduced the word. Why did I just go blank?
Chunking?
Yes. And what that is being able to look at the market very much like you learn to back your car out of the garage. Well, the first time you do it, it's very slow, and you're putting the key in, you're looking left and right. Every time you do it, it gets smoother and smoother and smoother. You get to become more with the car and with the situation. And what I want to get to the point was, when you look at a market, you see the point of control. You see the previous day's high and low. You see the overnight high and low. You see the point of control from overnight. You see a whole lot of information in a split second. one of the things I've said to people, I can move from one market to another, and sometimes it's not a very wide move because I'm looking at what the market is telling me, and I can look over there pretty quickly and get a feel for it. So again, it's a long-winded answer, but it's not one single thing. It's going back and being able to look at all the information, absorb it into kind of a single, holistic type of view. All right, let me answer a final question.
Okay. You have often said we should trade value. What exactly does this mean? Can you provide an example?
Okay. Yesterday was an inside day. What was value yesterday? Inside. What kind of a day did we get? Rotational. Today, value is higher. And value is higher. And what did we do? We went out and took out the overall high. Now, the rejection isn't very clear, but value is higher in there. So, in other words, and I said that early. Remember, two of the things early on, I said value is higher, and yesterday's high, the early morning high today did not look secure because it was a poor high. Okay, combining those two things, guess what? We came back and took out the all-time high. Now, where we go from there, things can change. We did come down and pull into the lower distribution, no follow through. So it's a low confidence market. But I will caution you that it's an options expiration today, and they can be a little more difficult. But value is a filter. It's a filter that helps you understand what is really going on in the market. It helps you control your emotions. Like I said yesterday, for those that got caught short, you're looking and saying they weren't going to make it. Was almost impossible to get value even to the value area low from the previous day. So I look at that, and that was very helpful, saying it's a rotational day. It's one of the factors that I'm continually looking at. Is value going to be higher or lower? Anybody can tell you what price is doing. You can look, price is up or down. The problem so many people have with trading is they're overly focused on price. And price is an advertising mechanism. What you want to know is the acceptance or rejection of those advertised opportunities. That is far more important than is the market up or down. And a lot of times, I actually don't know what price has done. I'm so tied to value and what the market did overall. Well, let me once again say thank you. And I really do hope a lot of you will consider our new intensive. Like I say, it starts February 26th. If you get enrolled, I will start on February 1st, providing you with an evening letter, a morning letter, and chats that pop up on your screen throughout the day. Once again, thank you very much, and good trading.
Thank you, everybody. This webinar will be recorded and posted later today for your viewing pleasure at your convenience. Thank you very much. Bye-bye.